All right, so you wanted to really get a handle on accounting journals, and we found some excerpts from a real accounting textbook to help us with that.
Oh, wow.
So we're going to go deep into the world of debits and credits, but don't worry, we're going to keep it lively.
Sounds good.
Think of it like this. A journal is basically a diary for your business's money.
Okay.
Every purchase, every sale, every cent that comes in or goes out, it's all got to be logged in a journal.
Yeah, that makes sense.
And I think what's so fascinating about journals is they're not just about recording numbers.
Yeah.
They're about understanding the financial story of a business.
Right. It's like piecing together a puzzle where each transaction is a clue.
Yeah.
And the journal helps you see the bigger picture.
I like that, a financial detective novel.
Exactly.
Now, I know there are different types of journals.
Mm-hmm.
Our source mentions special journals and a general journal.
Yeah.
What's the difference?
So imagine you're a chef with a well-organized kitchen. You have different cutting boards for different tasks, one for vegetables, one for meat, and so on.
Yeah.
Special journals are like those specialized cutting boards.
Okay.
They're designed to record one specific type of transaction, and that makes the whole process more efficient.
Okay, so if I'm constantly making sales on credit, I'd have a dedicated journal just for that.
Exactly. That's called a sales journal.
Okay.
Sometimes it's referred to as a sales day book.
Gotcha.
And it chronologically tracks all those credit sales with details like the date, the customer name, the amount.
Okay.
Our source actually has a great example from a company called Johnson Ltd.
Yeah.
It really brings the concept to life.
So let's say I'm looking at Johnson Ltd's sales journal for the month.
Yeah.
I can see exactly who bought what and when, which helps me analyze sales trends, maybe even spot those big spenders.
Precisely. And that's just one example.
Right.
There are special journals for purchases, sales returns, purchase returns, each one streamlining the recording process for a specific type of transaction.
Makes sense.
But what about those transactions that don't fit neatly into these categories?
Right.
That's where the general journal comes in.
Okay, so the general journal is like the everything else drawer in the kitchen.
Yeah.
The one where you keep all those random gadgets you might need someday.
That's a great way to put it.
Okay.
The general journal is a chronological record of all transactions.
Okay.
And it uses a system called double entry bookkeeping.
Double entry bookkeeping. Sounds a little intimidating. Can you break that down for me?
Think of it like a two-sided coin.
Okay.
Every financial transaction has two sides to it. For example, if you buy a new laptop for your business, you're gaining an asset, the laptop.
Right.
But you're also decreasing your cash.
Yeah.
Double entry bookkeeping ensures that both sides of this transaction are recorded.
So it's all about maintaining balance.
Yes.
Kind of like for every action, there's an equal and opposite reaction.
Exactly. That's a perfect analogy. In double entry bookkeeping, one side of the transaction is called a debit, and the other side is a credit.
Yeah.
These debits and credits always have to balance,
Right.
ensuring that the fundamental accounting equation assets equals liabilities plus equity
Right.
always holds true.
Okay. I'm starting to see the logic here.
Yeah.
But how does this actually play out in the general journal?
Let's look at a simple example from our source.
Okay.
Imagine an owner invests cash into their business.
Yeah.
To record this, we debit the cash account because the business is receiving cash, and credit the capital account,
Okay.
which represents the owner's investment in the business.
So even a simple transaction like that has these two sides
Absolutely.
that need to be recorded to keep everything balanced.
And the general journal entry would include not only the accounts affected and the amounts,
Right.
but also a brief explanation called a narration.
Okay.
In this case, it might say something like, being cash invested into the business by the owner. This ensures that anyone looking at the journal later understands the context of the transaction.
Those narrations seem super helpful,
Yeah.
especially when you're trying to make sense of things months down the line.
Yeah, definitely.
But what happens when a transaction is more complex? What if it affects more than just two accounts?
That's where compound journal entries come in.
Okay.
They involve multiple debits and credits,
Uh-huh.
but the core principle remains the same. The total debits must always equal the total credits. Think of it like a more intricate dance, but the partners still need to move in sync.
Okay, that makes sense.
Yeah.
So give me an example of a compound entry.
Okay.
Something that'll really put this double entry bookkeeping to the test.
Let's imagine our friend from earlier, Johnson Ltd.,
Okay.
decides to invest in some new equipment. They purchase a fancy new machine for, let's say, $450,000.
Okay.
They pay $300,000 in cash up front.
Okay.
And the remaining $150,000 is financed, basically a loan they'll pay back later. This single transaction actually affects several accounts.
Okay, so we've got the machine itself,
Yeah.
which is an asset for the company.
Right.
We've got the cash they paid, and then this loan.
Right.
Where does that fit in?
That loan represents a liability for Johnson Ltd. Because they owe that money.
Right.
So in addition to debiting the machinery account for $450,000 and crediting cash for $300,000,
Right.
we'd also credit a liability account called accounts payable for the remaining $150,000.
Wow, so one transaction,
Yeah.
but 3 accounts are impacted.
Uh-huh.
But by using this double entry system, all the pieces still fit together perfectly.
Right,
Wow.
precisely. The general journal allows you to capture all the nuances of a complex transaction in a single entry,
Yeah.
while still ensuring that everything remains balanced. It's like a well-choreographed dance where each step contributes to the overall harmony of the performance.
I like that.
Yeah.
Okay, I'm starting to see how this double entry system is like the backbone of accounting, keeping everything aligned. But honestly, when I first heard about journals, I thought they were just for accountants hunched over spreadsheets. Why
Yeah.
should the average person or even small business owner really care about these?
That's a great question, and it's one I hear a lot. While accountants certainly live and breathe journals, their usefulness extends far beyond the accounting department. Imagine you're running your own business. Wouldn't it be helpful to have a detailed record of every financial transaction?
Yeah.
It's like having a financial GPS helping you track where your money is coming from and where it's going.
Okay, so it's not just about recording the numbers. It's about understanding what those numbers are telling you about your business. Our source mentions a few specific benefits of using general journals. What are some of the highlights?
Well, one of the most practical benefits is that general journals help you track those miscellaneous transactions that don't fit neatly into the specialized journals. Think about things like bank fees, loan payments, or even that time you bought office supplies with your personal credit card and need to reimburse yourself.
Right.
These might seem like small potatoes,
Yeah.
but they can add up.
Oh, I know that feeling. Sometimes it's like those little expenses just vanish into thin air. But with the general journal, you've got a record of every penny. So there's no more mystery about where the money went. That's got to be a relief for business owners.
Absolutely. And another key benefit is that general journals are essential for making those year-end adjustments.
Yeah.
Things like depreciation, the gradual decrease in the value of an asset over time, or accrued expenses, those expenses you've incurred but haven't yet paid.
Wait, back up a second. Accrued expenses. Can you give me an example of that?
Sure. Let's say you have employees who worked the last week of December, but they won't get paid until the first week of January.
Okay.
That unpaid salary is an accrued expense for December, even though the cash hasn't actually gone out yet.
Right.
You need to recognize the expense in the period it occurred, not just when the cash changes hands.
So it's about accurately reflecting the timing of those expenses makes sense.
Exactly. And then there's prepaid expenses, which is kind of the flip side.
Okay.
Let's say you pay a year's worth of insurance premiums up front. Each month, you adjust the accounts to recognize the portion of the insurance that's actually been used up in that month.
Okay. I'm seeing how these adjustments can make a big difference in getting an accurate picture of the business's true financial health. But let's be honest.
Yeah.
We all make mistakes sometimes.
Yeah.
What happens if I mess up a journal entry? Is there any way to fix it?
Don't worry, you're not alone. We all make mistakes, and that's where the beauty of the general journal comes in.
Okay.
You can make correcting entries to fix those bookkeeping blunders without having to tear your hair out.
Right.
Let's say you accidentally recorded a sale twice. You'd make a correcting entry in the general journal to reverse that duplicate entry and bring your accounts back into balance.
It's like having a financial undo button, and those narrations we talked about earlier are even more important in these situations, right? You want to be super clear about why you're making those correcting entries.
Absolutely. It's all about transparency and accountability. A clear audit trail ensures that anyone reviewing the journals can understand why adjustments were made. But beyond these day-to-day benefits, journals also play a crucial role in creating those all-important financial statements, the balance sheet, and the income statement.
Okay, you're speaking my language now.
Right.
I was hoping we get to these. I've heard these terms thrown around, but I'm a little fuzzy on what they actually are and how they connect back to these journals we've been dissecting.
Think of financial statements as the reports that summarize a business's financial performance over a specific period, usually a month, a quarter, or a year. The balance sheet is like a snapshot of the business's financial position at a particular point in time.
Okay.
It shows what the business owns as assets, what it owes its liabilities, and the owner's equity.
So if journals are the detailed daily logs, the financial statements are like the monthly or yearly summaries, right? Like here's where things stand overall.
Exactly. They take all those individual transactions and condense them into a more digestible format. The balance sheet follows the basic accounting equation we talked about earlier. Assets equals liabilities plus equity. It has to balance out. Now, the income statement is more like a video showing how much revenue the business generated over a period, its expenses, and whether it made a profit or a loss.
So the balance sheet is a snapshot in time, and the income statement is tracking the flow of money over time. Got it. But how do those detailed journal entries actually feed into these summary statements?
Great question. It's all about connecting the dots. For example, all those sales were recorded in the sales journal contribute to the revenue figure on the income statement, and those expense entries, like the salaries we talked about, they get factored into the expenses section of the income statement. Each journal entry is like a piece of a puzzle, and when you put them all together, you get a complete picture of the business's financial performance.
So it's not just about recording those individual transactions in isolation. It's about how those transactions ultimately come together to tell the financial story of the business. And that story can help business owners make smarter decisions, right?
Absolutely. By analyzing these financial statements, business owners can gain valuable insights into their operations. They can see which products or services are most profitable, identify areas where they might be overspending, track their cash flow, and get a clear understanding of their overall financial health.
This is starting to make so much sense. It's like those seemingly mundane journal entries are actually the foundation for making strategic business decisions. But you know what would really bring this to life? Seeing a real-world example of how this all works in practice.
You read my mind. Our source has a fantastic case study featuring a company called Chigozi Enterprises. It's like a mini deep dive within our deep dive. They start with a set of beginning account balances, and then we see how a series of transactions impact those balances and how those transactions are recorded in the journals.
Okay, I'm ready to put on my accounting hat and see this in action. Let's dive into the world of Chigozi Enterprises. All right, so we're diving into the world of Chigozi Enterprises, a small business that's going to show us how these accounting journals work in real life.
Yeah, it's a great example of how even a business that might not have a huge accounting department can still benefit from the structure and insights that journals provide.
So Chigozi Enterprises starts with a set of beginning account balances, their financial starting point, kind of like setting the stage for our story.
Exactly. And then our source walks us through a series of 10 transactions that occurred during a specific period. Each transaction impacts those balances, and each one needs to be carefully recorded in the journals.
Okay, so let's take a look at a few of these transactions.
Okay, sounds good.
Transaction number 1, it's pretty straightforward. It says purchases on account N1100. How would we record this in the general journal?
Well, when a business purchases goods or services on account, it means they're buying on credit.
Right.
They receive those goods or services now, but they'll pay for them later.
So it's like putting it on a tab.
Exactly. And to record this in the general journal, we debit the purchases account for N1100.
Okay.
This increases the value of the purchases account, reflecting that Chigozi Enterprises has acquired more goods.
Right.
And because they're buying on credit, we'd credit the accounts payable account for the same amount.
So the accounts payable account is basically keeping track of everything the business owes to its suppliers.
Precisely. And you can see how this single entry illustrates the double entry bookkeeping system. For every debit, there's a corresponding credit, ensuring that the accounting equation stays balanced.
It's all coming together. Okay, let's jump ahead to transaction 3, which involves both cash sales and sales on credit.
Okay.
We talked about this concept earlier, but I'm curious to see how it actually plays out in the general journal.
Absolutely. Remember, we have two options here.
Right.
Separate entries or a combined entry. Let's walk through both to highlight the key differences.
Okay.
For the separate entries, we'd first record the cash sales with a debit to cash because cash is coming in.
Right.
And a credit to sales to recognize the revenue earned.
Okay, that's the cash sales side then. For the sales on credit, we debit accounts receivable because the money isn't coming in immediately, and credit sales for the value of those sales.
Exactly. Now, if we wanted to combine these two transactions into a single compound entry,
Right.
we'd still debit cash for the cash sales and accounts receivable for the credit sales.
Oh.
But instead of crediting sales twice, we'd make one single credit to the sales account for the total value of both the cash and credit sales.
So it's basically a more streamlined way of recording the same information.
Yeah.
But regardless of which method you choose, the fundamental accounting equation still holds true.
Exactly. The beauty of the double entry system is that it ensures accuracy and balance no matter how you slice it. Okay. Are you ready for a slightly more challenging transaction?
Bring it on. I'm feeling like a seasoned accountant now.
All right, then let's look at transaction 7. Cash received now for revenue of next period, N550.
Okay.
This one introduces the concept of deferred revenue, which can be a bit tricky.
Ah, yes. Deferred revenue. The cash is in hand, but you can't actually count it as revenue yet.
Exactly. Remember, deferred revenue occurs when a business receives cash up front for goods or services that it hasn't yet delivered or performed. They have the cash, but they haven't actually earned it yet.
So how do we record this in the general journal?
Well, we know that Chigozi Enterprises received cash, so we debit the cash account for N550.
Okay.
But instead of crediting a revenue account, we credit a liability account called deferred income for the same amount.
So the deferred income account is acting as a temporary holding place for that cash until it can be recognized as revenue.
A perfect way to put it. And as Chigozi Enterprises delivers the goods or services in the next period, they'll reduce the deferred income account and recognize the corresponding revenue.
So it's all about accurately matching the revenue with the period in which it was actually earned.
Precisely. And this concept of revenue recognition is crucial for ensuring that the financial statements accurately reflect the business's true performance. It wouldn't be fair to record the entire amount as revenue now when the service or product hasn't actually been delivered.
This Chigozi Enterprises case study has been incredibly helpful in bringing all these journal concepts to life.
Yeah.
We've seen simple transactions, compound entries, and even tackled the concept of deferred revenue. I feel like I'm starting to get a real grasp of how this all works.
I'm glad to hear it. Remember, these journal entries might seem like individual bits of data, but they're actually the foundation for understanding a business's financial story. They're the building blocks that allow us to create those insightful financial statements, analyze trends, and ultimately make informed decisions about the future of the business.
It's amazing how something that seems so technical at first can actually be so fascinating and even empowering. Who knew journals could be the key to unlocking a business's financial potential?
And that's the beauty of accounting. It's not just about crunching numbers, it's about using those numbers to tell a story, to understand the past, and to shape the future.
Well, I think it's safe to say that you've demystified journals for me today. We've seen how they work, why they matter, and how they connect to the bigger picture of financial reporting. I'm feeling a lot more confident about navigating the world of debits and credits.
That's fantastic to hear. And remember, this knowledge isn't just for accountants. It's for anyone who wants to understand how businesses operate, how financial decisions are made, and ultimately how to gain a better understanding of the financial world around us.
I couldn't agree more so. For anyone listening who's feeling inspired to explore further, I encourage you to dig into some real-world examples of financial statements, or even check out different accounting software programs. There's a whole world of financial knowledge out there waiting to be discovered. And who knows, maybe one day you'll be the one creating those insightful journal entries and shaping those compelling financial narratives.
Exactly. So keep exploring, keep learning, and keep that financial curiosity alive.